In Chapter 13, we will be reviewing problems P1341A and P1342A. In P1341A, we have D-Mobile Wireless needed additional capital to expand, so the business incorporated. The charter from the state of Georgia authorizes D-Mobile to issue 50,000 shares of 8% $50 par value cumulative preferred stock and 160,000 shares of $4 par value common stock. So it's just giving them the permission to sell that. They're not actually selling that, but that's the maximum. That's what they're authorized to sell. In requirement 1, we need to record the following sales. So on October 2nd, the company issued 19,000 shares of common stock for a building with a market value of $240,000. So the company debits the building account for $240,000. Now, as stated in the chapter, the most you can credit the common stock equity account for is the number of shares times the common stock's par value, or 19,000 shares times $4 a share, $76,000. Now, they sold the stock essentially for $240,000. So the $164,000 difference is put into the equity account paid in capital in excess of par. So the amount of paid in capital the company received when it first sold the stock above the par value. And that account is increased on the credit side. In October 6th, the company issued 600 shares of preferred stock for $140 a share. Well, the company's preferred stock has a $50 par value. You must keep that in mind. Par value is not selling price. Selling price of this stock is $140 a share. $140 is then multiplied by the 600 shares, and in this case, they sold it for cash. So the company will debit cash for $84,000. They only credit the preferred stock account, which is similar to common stock in that it is selling ownership to the outside to a stockholder, $50 par value times 600 shares. So you follow that same rule. The most you put into the preferred stock account is the stock's par value. So $30,000 is the amount of the credit. The amount they received above the par value is credited to the other equity account paid in capital in excess of par preferred. On the 9th, the company issued 11,000 shares of common stock for cash of $55,000. So the company will definitely debit cash for $55,000. They only give us a total here, but if you take the $55,000 they received in total divided by the $11,000 or 11,000 shares, you'll get a per share sale amount, or $5 per share. So they sold it for $5. Par value is $4. So the most you credit the common stock account for will be the $4 par value times 11,000 shares sold, or $44,000. The $1 they sold it above par value times 11,000 shares is put into, or credited to, paid in capital in excess of par common. So those demonstrate how to record the sale of stock either for cash or for another asset. Now, the next two journal entries relate to cash dividends. As stated in the chapter, dividends have three distinct dates: the date of declaration, the date of record, and the date of payment. In this case, October 10th is the date of declaration. That's the day the board of directors says, we're going to pay a dividend. And in this case, the board of directors said they were going to pay a $19,000 cash dividend to all the stockholders in total. That's common and preferred in total. On that day, they debit cash dividends $19,000. So they have to debit the dividend account. They're not paying the dividend. And they also didn't define who is getting what, how much of that dividend. That's up to us to decide. How do we determine it? Well, remember from your reading, preferred shareholders always get their dividends first. So we will go and say how many shares of preferred stock have been sold. There are 160,000 authorized to be sold. But how many were actually sold? Well, the only ones that are sold so far are 600 shares on October 6th. So how we calculate the amount of the dividend is we take the number of shares sold, or 600, multiply it by the stock's par value, $50. Am I looking at that right? Yep. Okay. That result is called the total par value. Well, the amount of the dividend is a percentage of that total par value, and it is defined on the stock certificate for the preferred shareholders. And that's what the 8% is telling us. The percentage of par value one share of preferred stock gets as a dividend. So take 8%, $2,400. So we credit a liability account on the date of declaration called dividends payable preferred, $2,400. The remaining amount of that dividend is then promised to the common stockholders because remember, they get the leftovers. So on the date of declaration, we debit the cash dividends, determine the amount of dividends that will go to the preferred shareholders and the amount that will go to the common shareholders, and credit dividends payable for those amounts and separately. The date of record, there is no journal entry because if you remember, the date of record is the cutoff date for ownership. People who own the stock on that day are the ones who will get the dividend. And then finally, the payment date, which is October 25th, we pay out the dividend. So you debit the to dividends payable account because you're paying off that liability now, and credit cash. And that's how we handle cash dividends. The second part of the problem wants you to prepare a stockholders' equity section for this company at October 31st. And this is great practice because we get much more detailed now than we once had on the balance sheet when we just did a sole proprietor. You have to remember, with stockholders' equity, which is our new owner's equity, but we call it stockholders' equity because it's a corporation. There's a lot of stuff happening. There are two sections of stockholders' equity. The first is paid-in capital. Paid-in capital is where we store the total dollar amount the company receives when it sells stock for the first time. So that one share of stock, when it was sold, the total amount the corporation receives goes in that account. And really, that's the only time the company will do anything with the stock accounts unless they're directly involved in the transaction. So once they sell the stock and it's being sold out on the market between other people, they're not involved in that process. There's no journal entries related to those other transactions on the books of the company. Now, paid-in capital, then, there are 4 accounts that we dealt with that would be considered in this section because think about where we recorded the amounts we received, or the amounts we actually paid when we sold stock, or received when we sold stock for the first time. For common stock, it was the common stock account and paid-in capital in excess of par common. For preferred stock, it was preferred stock and preferred stock in excess of par. Paid-in capital in excess of par preferred. Sorry, I'm getting all my P words mixed up. So we always list preferred stock first on the stockholders' equity section if the company has it. We put the dividend rate and the par value. And then we list 3 important descriptions of the stock. The total number that are authorized to be sold, so 50,000. The total numbers actually sold and outstanding, 600. and then the balance of that account, which is $30,000. So I suggest you go back to your journal entries and make T accounts for these various accounts and post the information into them, and you will see where these balances are coming from. Paid in capital in excess of par preferred was credited in our journal entry for $54,000. So that's the balance of that account. Then we go to common stock. Common stock, you list its par value. There is no dividend rate. Remember, they get leftovers. The number of shares they're authorized to sell in total, and the actual number of shares they sold, which are 30,000. 19,000 on October 2nd and 11,000 on October 9th. So they have two transactions that increased common stock, which would total $120,000. They also had two transactions that affected that paid in capital in excess of par common. So when we add up, and that equals $175,000. So when we add those $4 amounts together, total paid in capital for this company is $379,000, which is the total amount the company received when they sold these shares of stock. We just split them up between various accounts because of par value. The other major section of the stockholders' equity is retained earnings, and you are already familiar a little bit with it. Retained earnings is where we keep track of the earnings that are still in the business that have not been paid out as dividends. So retained earnings is a T account. It increases for net income. Earnings go in there when we close them out at the end of the year. And in this case, they tell us the company's net income is $94,000. So retained earnings would be increased for that dollar amount. Retained earnings decreases for dividends. So any cash dividends, which would be the $19,000, will be closed to retained earnings and subtracted from it. So that gives us the balance in there of $75,000. So when we take all the money we received the first time we sold stock, plus the earnings minus dividends, which are like withdrawals, total stockholders' equity is $554,000 for this company. And that's how we present the equity section for a corporation. Now in problem 1342A, we have Dearborn Manufacturing. They completed the following transactions. So the first thing we have to do is record journal entries. The very first one is a practice of our cash dividends. Declared a cash dividend on 6% $103 par, non-cumulative preferred stock. There's 1,050 shares outstanding, which is also the amount sold. They declared a 20 cents per share dividend on the 100,000 shares of $2 par value common stock outstanding. The date of record is January 31st, and the payment date is February 15th. So they define all those dates for us. So first, let's determine the total amount of the dividend. Well, they declared a dividend on the preferred stock, which is 1,050 shares outstanding. So we always use outstanding shares when we're determining a dividend, and we'll explain that in a few minutes. So 1,050 shares times the par value, remember you use par value, times the dividend percentage, which is 6%. So the amount of the dividend for the preferred stockholders is $6,489. In this declaration, they don't give us the total amount of the dividend. They tell us we're going to give preferred stockholders their normal dividend, and common stockholders who have 100,000 shares outstanding, and that's what we'll use, the 100,000 shares, will get a 20 cents per share dividend. Multiply 100,000 times 20 cents, $20,000. So you would credit dividends payable common $20,000. Add those two together, and that's your debit to cash dividends. The date of record is ignored for our purposes. That's a name collection date. The next important date would be February 15th when the cash dividends are paid. And just like in our prior problem, we would debit dividends payable, preferred, and common, and then credit cash. On June 10th, the company announces a 2-for-1 stock split, meaning for every one share of common stock a stockholder had before, they now will have 2. The par value also is decreased by that same ratio. So we would take the $2 par value of the common stock divided by 2, it will now have a $1 par value. Companies declare stock splits to put more stock into the stock market, and this tends to lower the market price of the stock so that it becomes more marketable to people who don't have a lot of money to invest. More people have access to the stock. They're pretty common. The next journal entry, July 30th, the company declared a 30% stock dividend on the common stock, and that's normally where your stock dividend is. They're not sending out cash, they're actually sending out new shares of stock. They declared this when the market value of the common stock was $9 a share. Now remember from your reading, a stock dividend, there are small stock dividends and large stock dividends. If the stock dividend is less than 20%, it's a small stock dividend. If it's more than 25%, it's a large stock dividend. In this case, then, we're dealing with a large stock dividend. In either case, we always need to compute the number of shares that are being sent out in this stock dividend. So if this is a 30% stock dividend, we would take 30%, not by 100,000, because remember there was just a stock split. There are now 200,000 shares of common stock outstanding. So 200,000 shares times 30%. So the company's sending out 60,000 new shares as a dividend. Now, how do we value that? Small stock dividends, we would use the market value. With a large stock dividend, though, we use par value. So that's first of all, that's why we're using the dollar per share par value. Remember, the dollar par value was created when we just had that stock split. The journal entry to record a stock dividend is you debit a stock dividend account that will be closed to retained earnings, just like cash dividends are closed to retained earnings. We credit an equity account. So this account appears in stockholders' equity called common stock dividend distributable. And it sits there until the payment date or distribution date of the stock dividend. Now, when the stock dividend is actually distributed on that date, on August 15th, you debit common stock dividend distributable, that equity account you just stored the 60 grand in, and now you could credit common stock because it was sent out. So it's just kind of a resting area until the actual distribution date. Okay, so that's how we handle cash dividends and stock dividends. Now, the only difference for a small stock dividend would be we would use the market value to determine the value of the stock dividend. In this case, we used par value. It's just the rule. The next 3 journal entries deal with a special label we put on common stock. When a company purchases back its own stock, and it does it for many reasons. It wants to be an investor too. They may need stock in the company because they promised it out. Sometimes they buy it back out of the market to help raise the price of the stock, because when there's less of something in the market, the price tends to go up. So there's many different reasons, and they talk about them in your book. So take a read through them. But how do we handle it from an accounting end? Well, on October 26th, the company purchased 1,000 shares of its own common stock, which we label treasury stock. They paid $8 a share. So what we do is we debit a contra equity account, a contra equity called treasury stock, for the amount we paid for it. So this was Dearborn's stock. They sold it at some point out into the market. Now they're buying it back out of the market. label it as treasury stock, store the dollar amount in a contra equity that originally we're buying it back at, 8,000 shares, credit cash. Okay, so I would suggest you make a little T account just so you could see the flow of this if you have a piece of paper. I'm going to get mine going here. Okay, so we just debited that contra equity account for 8,000. Remember what's in it? 1,000 shares of our own stock that we own, that we bought back at $8 a share. Now we could sell that back into the market, and we're not selling new common stock. We're selling common stock we had sold, bought back, and now we're going to resell it back out. So on November 8th, the company sold 500 shares of its treasury stock, so half of what they just bought back, for $10 a share. So you take 500 times 10, that'll give you the $5,000 cash. Okay. How much do you take out of the treasury stock account? Well, the number of shares sold times the amount we bought them back at, which is the $8 per share. So the treasury, that contra equity account, is credited for $4,000. So we just sold that back for $5 when we paid $4. So we made $1,000 on buying our own stock back and reselling it into the market. But we don't credit a gain account. We credit a paid-in capital account, kind of like paid-in capital in excess of par. It's the same type of account, will be reported in paid-in capital, but it's called paid-in capital from treasury stock. So I would make a T account, PIC, paid-in capital, treasury stock. And what's in there? Amounts that we sell our treasury stock for above what we originally bought them at. That's all that's in that account. Okay. November 30th. The company sold 300 shares of the treasury stock for $4 a share. So they sell 300 shares times $4, that's $1,200. They receive in cash, so we debit cash. They have to credit the treasury stock for 300 shares times $8, what they originally bought it for. So they're crediting it for $2,400. So they received $1,200 on something they paid $2,400 for. So there is a total loss of $1,200. How do we account for that loss? We don't debit a loss on sale account. No. What we do is we ask ourselves, do we have a paid-in capital from treasury stock transactions? Paid-in capital from treasury stock transactions account. If we have one, we debit that account till it reaches zero. So we have that account. It has a $1,000 credit balance in it. So debit that for $1,000. You can't debit it so that it ends up with a debit balance in it. Debit it until it reaches zero. Any excess that you still need a debit for, you still have some loss, we debit retained earnings. So in this case, when you sell treasury stock at a loss, you debit the paid-in capital until it reaches zero, paid-in capital from treasury stock. So we had that account. But what if we didn't have that account? We would have debited all $1,200 to retained earnings. You would have debited that retained earnings account for the $1,200. We decreased the amount of earnings available to be paid as a dividend, and that's what's in retained earnings. Okay, so that is how we handle treasury stock transactions. Now, in the second part, how do we record this as in stockholders' equity? And this, you really should do some T accounts here so you can see what's happening. I'm just going to explain it. Remember, paid-in capital, non-cumulative preferred stock, we do our dividend rate, par value, 103 par value, 2,600 shares are authorized, 1,050 shares are actually issued. They give us that information in requirement 2. Okay, so how much par value is there? 108, 150. Now in the part 2, they don't say anything about paid-in capital in excess of par for either one of these. So we may have sold them at their par value, and that's fine. But watch what happens with common stock. In part 2, they tell us that there's Okay, they're giving us the number of shares that are authorized after the stock split. So common stock now has a dollar par value. 400,000 shares are authorized to be sold. Of that, 260,000 shares are sold. Where do we get that from? Well, back up on January 16th, there was 100,000 shares originally outstanding or sold. But there was a stock split. So now there's 200,000 shares. And then right after that, they send out another 60,000 shares as a dividend. So that's where we get the 260,000 shares. Those are the amounts that are issued, sold to everybody. But then we have this other description of stock, and it's called outstanding. And it's the outstanding shares of stock that actually get a dividend paid on them. What are outstanding stocks? They're the number of shares that are issued minus the number of shares held as treasury stock. So this company owns 200 shares of its own stock, treasury stock. Still, remember they bought 1,000, sold 800 of them back. Treasury stock does not get paid a dividend. So that's why we subtract them from the number issued and report outstanding at 259,800. So the three words we use to describe stock: number authorized, that's the total number you can sell. Number issued, that's how many of those you have sold so far to everyone. Outstanding, the number of issued minus any treasury stock you currently own. The par value then is 260,000, or the amount in common stock. So total paid in capital, how much did this company receive the first time they sold stock? $368,150. It comes right out in part 2 and says, hey, retained earnings has a balance of $2,060,000. So we list that. Two major parts of equity: paid in capital and retained earnings. Now, since this company still has treasury stock balance, they have 200 shares that they paid $8 for that they haven't sold yet. That contra equity account, treasury stock, the balance of it, which is $1,600, would be subtracted. It's a contra equity. So total stockholders' equity would be the total paid in capital plus the retained earnings minus the $1,600 balance in treasury stock. If there was no treasury stock, you wouldn't put anything. So total stockholders' equity, $2,426,550. So this problem takes care of that second part of the chapter where we focus on stock dividends and treasury stock and how they affect the stockholders' equity. So if you have any questions, please post them.